Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Alex Coffey, Senior Trading and Derivatives Strategist at Charles Schwab, as well as Sean Dranfield, CEO of PTAM. We're here to discuss investor behavior and opportunities in today's unpredictable environment. It's great to see the both of you. As always, the Chicago contingent on the show again. Alex, let's kick it off with you. It's just remarkable to watch this market, not just for year to date, but we consistently hit new highs virtually every day. It seems as if investors are reading in between the lines on the headlines.
Yeah, what a year so far, Jill. Good to be back as always. But when you look at the recovery and the continued success, it's hard not to be optimistic about, the future. I mean, we tend to see all-time highs cluster. You tend to see volatility cluster. You got that pocket of volatility back in the first quarter, but since then, it's been relatively smooth sailing. I sent over a couple charts to you guys. If you pull up the first one, this goes back to January 1st of 2024, where every candle's a day. And I just used a linear regression line, which is that yellow line on the chart. And when you pull it up, what you would have seen is that basically this has been a pretty steady uptrend throughout. But more importantly, Jill, I added on there some standard deviation channels. And, if we don't have the charts, that's fine. I can explain
I apologize
what we're
about
looking
that.
at.
We don't have the chart, but
no worries about that. But what we could see is we're within the bounds, and we're still within one standard deviation, even with this rally. And what that goes to show is, it easily could still have more legs. It could easily still continue. And the Nasdaq has led this rally from the lows, and it absolutely continue to do that.
Yeah. And what's interesting, Sean, is that you're inserting some uncertainty around the Fed, not just in terms of what it's going to do with interest rates, but what leadership is going to look like. So that is another variable that has recently been put into the investor equation.
Yeah, absolutely. And I would actually echo some of Alex's comments as well, because, despite all the headlines we heard about volatility and trade, et cetera, like Alex suggested on the equity market side, I mean, frankly, the volatility that we've had in the bond market, notwithstanding sort of the tariff noise, has been somewhat muted relative to history, which I find quite interesting. And similarly, if I pick on the 10-year Treasury, it's down on the year. So that means the 10-year Treasury is up, right? Because yields go down, prices go up. But notwithstanding that, to your point, Jill, as it relates to the Fed, I thought it was fascinating, particularly the conversation that Secretary Bessent had with CNBC earlier in the week, where, he was talking about a review of the Fed. And if you take a step back and you think about the Fed's mandate, it's fascinating to me that you have a group of highly educated, very smart, experienced people being asked to read sort of macroeconomic tea leaves, to take a view on GDP and inflation, and then set interest rate policy off the back of that. And even in the best of times, without tariffs or things like COVID, that's a very, very difficult proposition. There's overwhelming evidence that neither the Fed or Wall Street economists do a good job at consistently predicting rates. So when the secretary asks, well, should we review the Fed's mandate? I don't know exactly what he's implying, but I think one of the questions should be, well, is the supposition underlying the Fed, does that work? And I think there's good reason to ask that question. So I think it'll be very interesting to see if and how that plays out in the coming months.
I think it's also interesting to ask the question, Sean, as well, is the data that the Fed is relying on, is that relevant in today's day and age, and the composure of different asset classes in the markets? I mean, the real-time data is available in 2025, and you're still using surveys and data points that are many times 30 to 60 days behind, which makes it even more challenging. I mean, is it really a true read into how the consumer is behaving, as one example for the data point? And I feel as if many market participants are asking those kinds of questions, if in fact the data is relevant to what they're trying to set the economy up for.
Absolutely. And I remember back in the 90s, the common phrase was when the US sneezes, the rest of the world catches a cold, right? And now we have this so much global and international interdependency of countries, supply chains, et cetera. So I would agree with you, reading, the tea leaves that have been read historically, you've got to ask yourself, does that actually help? And it reminds me, of the movie Moneyball, right? Where, hopefully you both have seen the movie, but I remember that classic scene when Brad Pitt was sitting in this room with these sort of curmudgeon-y old, experienced sort of scouts, and they were all advocating, batting average is the way to review players. And he said, no, 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 let's look at on-base percentage. And I sort of think of those old guys as the Fed, and to your point, are they asking the right set of questions? Maybe we need a different answer as it relates to how the Fed operates in this sort of new global economy.
Just saw Moneyball for the first time over the weekend. Alex, we got your charts to function, which is a good thing because I want to ask you about the 20-year seasonality chart and what you can discern as it relates to performance in the Nasdaq 100 index.
Yeah, no, I echo so much of what Sean just said as well. I mean, we just had the Open Championship, and we want to find the winner before those type of golf tournaments. But sometimes you're overthinking it. Scotty Scheffler was the favorite going in. He dominated the tournament the same way the Nasdaq has dominated equity index performance. And interestingly enough, if you were to look at this same seasonality chart for the S&P 500 year to date, the S&P 500 is outperforming its 20-year seasonality. The NASDAQ is actually running behind. So we've talked about it leading the performance. We've talked about its incredible comeback. But one could argue, again, more upside could be had just simply because it's lagging what just the average year is over the last 20 years. So we look at the chart, the red line represents the last 20 years on average. The teal line represents year to date so far. So obviously a more volatile year so far in 2025, as would be expected with the drawdown and recovery that we've seen. But the one cautionary note that I would note here is, this is just one factor, but we are entering a more seasonally consolidating period of time in this, late summer, early fall time period. And this tends to last on average from the early parts of August into, let's say, the latter parts of October. So doesn't mean that it's a reason to, run for the hills, but it is one, factor to consider, especially given the outperformance, the all-time highs, the pretty excessive valuations, particularly compared to some of those international markets like Europe that still exist. This could be just that time to consider if you're an investor, you didn't like your performance maybe in the first quarter, it was a little bit more volatility than you wanted, to consider paring back or even hedging some of the portfolio.
Yeah, so let's talk about what Schwab traders are doing specifically. The Schwab Trading Activity Index is what we refer to as the stacks, comes out, I believe it's the first week of each month, and it's been pretty consistent with investors remaining in the market, perhaps a slight dip in May, a little bit of an increase in June. Are there certain sectors or stocks that they are warming up to or backing away from, or is it more of a mixed bag? Anything you could tell from what came out the first week of July that could be of note?
Well, the one thing I would say that is really, really important and something to take away is, like we were talking about, whether that's in the Moneyball consideration of a new way of looking at the market, or just looking at who's playing the best right now and not overthinking it. I think Schwab clients are going back to what they trust. Now, they have taken the opportunities in names like NVIDIA, let's say, over the last couple of months to, lighten up after the really nice comeback. But for the most part, they're trusting the names that have led them to the promised land over the last few years. And that's a trend that we expect to continue, whether it's, an NVIDIA, a Tesla, a Microsoft. Those have been the generals of this market. And yeah, it's been concentrated for several years now. And if you've been worried about that, you've underperformed. Even if it was prudent, you've underperformed. I think retail investors see the same things.
All right. This has been pretty consistent with strategists that have been coming on the show as well. Let's talk about some opportunities in fixed income here, Sean. Some areas that we should be thinking about, other areas to avoid.
Yeah, so if I continue sort of the Moneyball analogy for a second, I would argue that the way people should think about bonds now, unlike sort of old traditional metrics, interest rate predicting, yield and duration, that are pretty flawed traditional metrics, we take the view you can't predict rates, and bonds are mathematical instruments. So you can look at real world price drivers of bonds and try to combine bonds that generate more of a rate agnostic total return profile. So when I think about the bond market, I think about offense, bonds that'll help you if rates go down, and defense, bonds that'll help you if rates go up. On the offensive side, we've had this big steepening in the yield curve. And what that's done is it's created go forward math at the longer end of the curve that's much more attractive. So we would argue, in a rates down world, 20-year treasuries, taxable munis, longer taxable munis, even in a moderate rates down world could generate equity-like returns with very little credit risk. On the defensive side, so rates up, high quality, very short structured credit that generates total returns in excess of money markets with nice high single digit total returns, frankly offer better go forward carry than more traditional IG corporate bonds that are typically 10-year bonds and rate sensitive. Like that combination in this environment, we think could play out very well on a go forward basis.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.